Hello, everybody. This is Toni Turner, and welcome to the market now as of Friday, December 15th at about 1:30 p.m. Eastern. Well, the S&P 500 and the Dow slipped slightly from yesterday's high after comments from a policymaker dampened recent investor optimism that the Federal Reserve could start money policy easing early next year. New York Federal Reserve President John Williams pushed back this morning on surging market expectations of interest rate cuts, saying the U.S. Central Bank is still focused on whether it has monetary policy on the right path to continue bringing inflation back to its 2% target. And on that note, let's go on to three charts and look at what may take place in the future this week. As we always do, we're going to first look at a daily chart of the S&P 500 SPDR, symbol SPY. Of course, this is the exchange-traded fund that closely follows our benchmark S&P 500 index. Now, when I captured this chart today, the SPY was trading at $470.13. Again, as you can see here, just off of yesterday's highs, the high was $473.73 yesterday, and that's barely below its all-time highs at $479.98 in January of 2022. Now, we know, and you can't see the whole year on the chart, but if you look left here, we know that the SPY moved in a really nice uptrend the first half of this year to gap open, that famous July gap open, and made an intraday high right here at $459.44. Now, of course, we know the SPY dropped after walking up the 20-day moving average. It gapped up in July, then dropped down through the 20-day moving average right here, the green line, the 50-day moving average, and then, as I say, made a reluctant downtrend, making lower highs and lower lows all the way down to its low in October 27th, down to $409.21. That was an 11% drop. Also, it's funny, if you look at this chart, this $409 it came down to was, interestingly enough, support from May of this year. So there was actually quite a bit of potential price support there, but it dropped right down to it, right down to that 409, and then turned around and started rallying again quickly. We also know that interest rates started falling in October, and of course that was a lot of the impetus. From that 409 low, the SPY bounced, and it started rising. It's been a very steep move up to about 455, just over the 50-day moving average. Over the a little consolidation here at 435 over the 50-day moving average, then another gap up here, and then it continued up to 455 where you see this consolidation coming back again to try to touch base with the 20-day moving average, but then said, nope, I'm going even higher, and again from there moved up to that 473.73 high from yesterday, and again now trading at 470. Now, what we want to note here, and we did note it last week, that the uptrends are very, very steep. I mean, are they fun? You betcha. They're a lot of fun to trade, but I've been in this business long enough to know that at some point, the SPY has to pull into a rest stop. At some point, some profit taking is going to come in. Can it maintain an uptrend? Certainly. But these angles are very steep. Actually, if you look back at the move up earlier this year, it was a much, pretty much a shallower angle than this rapid move up. So we remain overbought here. I talked about the RSI last week. It still remains above the 70 line, and it has stayed overbought. So that means that also means too, usually when the RSI gets overbought, we can see how it poked up here in June, and then price has to make somewhat of a, as I say, a rest stop or a pullback. We have support. We have price resistance all in all. We'll call it 474 from yesterday's high. And again, we're getting very close to that all-time high at 480. We also have potential price support here at the 20-day moving average, which is at 458. Call it 459 to make it easy. Then watch where we have here 450, 455, 454 right in here. This is potential price support. And so then we have to look at down here. The high of the gap is up here at 446. So there's an old saying in the stock market that all gaps have to be closed. Is that true or not? I don't know. We've got plenty of room for next week to bounce around a little bit in here, though. And remember, some traders will be taking off for the Christmas holiday season the closer we get to it. So just be careful here, trade wisely, and as I always say, please keep your stops in place. Our next chart today is a chart of the Invesco QQQ, symbol QQQ. This represents the NASDAQ 100, which represents the top non-financial companies by market cap in the NASDAQ 100. And we talk about companies like Apple, Meta, Nvidia, Alphabet, Tesla, that whole group. Now, when I captured this chart today, the Qs was trading below its all-time highs in November 2021 at $408.71, and today we're trading at $405.93. So we're only 3 points away from that all-time high. Now, we know that the Qs, a lot of tech stocks in here, we can't see the whole run-up from the first of the year, but we know that, like the SPY, the QQQ made an awesome uptrend earlier this year from the first of the year up to the July relative high at $388. Now, from there, it fell in a downtrend. It was not as severe as a downtrend as the SPY. It was much more shallow, much gentler in scope, but it finally did get knocked down because tech stocks always get, I shouldn't say always, I say usually get hurt when interest rates are higher. Most companies do. But this was a more gentle downslope for the Qs down to the October 26th low at $342.35. So you note that it fell through a couple of times. It fell through the 50-day and the 20-day, which became inverse, then dropped down to close to the 200-day moving average just to top it, almost using that for support, again at $342 and change. Now, this is the point right here where interest rates started getting lower, and we know that that affects the stock market in a positive way. So when interest rates rolled over a little bit, stocks started back up. Buyers came in, as I try to remind you here, don't forget the short, all the people who were short, or maybe not all of them, but many of them, they started covering, and when the shorts cover, they have to buy. So with the buying and then the buying, this market, the Qs, the tech stocks, momentum stocks moved up, really steep rally, and then up to November 14th, and it gapped up then right here, at November 14th to open at $383.71 right here. And when it did that, it climbed over all this potential resistance in August and September and so forth. So that was tough. Then it consolidated in a range here along 383 to 394 right here, consolidated in this range, then broke out again up to where it's trading today at $405.93. Now, we have to look at the RSI down here, the Relative Strength Index, and we can see that it has been overbought actually for a couple of weeks now. The overbought line comes in at 70. And the RSI here is actually at 76. So that means really overbought. So while stocks or ETFs like this don't necessarily drop the minute the RSI becomes overbought, it is kind of a warning to say, hey, in the next couple of weeks, some profit taking could come in here, at least in the short term. We are in an uptrend. It looks great, but nothing goes up forever. As you can see here, it had to consolidate. So just be careful here. And this uptrend is obviously bullish, as is the SPYs, but we need to keep our stops in place. Okay, so I looked at dozens and dozens of exchange-traded funds today. Many of them, as you know, are really overbought, and my goal is to buy low and sell high, not the other way around. So I did come over and look at the Consumer Staples Select Sector ETF, the XLP, very dependable ETF when things are going nicely, and maybe not as exciting as some, but I'm sure you've already had a bunch of excitement in the last couple of weeks or more. So we're looking again at the Consumer Staples Select Sector Spider Fund, the XLP. It has 38 holdings. Top holdings include Procter & Gamble, Costco. We all know how well Costco's done. PepsiCo, Walmart, Coca-Cola, and so forth. Things people need and want to have. When I captured this chart today, the XLP was trading at, right down here, $71.21. Now, let's look at it a little bit more here. Let's look left. From its July high right here, and it made that high. Of course, everybody made a high in July and then fell, right? So from its July high at $76.39. So right up here at about 76, it started rolling over, came down through the 20-day, the 50-day lined up with a 200. Price fell through that. Rallied a little bit, but couldn't keep going. Lower highs here and fell all the way down, like almost everybody did, down to October lows. So like many other industry groups, it fell lower here. It fell in a downtrend to October 6th right here and made an intraday low at $65.18. So when it opens near the highs of what turn out to be the highs of the day, then price goes way lower, then it comes up to close near the highs of the day. Sometimes that can be kind of a suggestion that maybe things will turn around a little bit here. That's a candlestick pattern. So it fell to its intraday lows at $65.18, that rallied back up to close. Then the XLP, if we back up and look at it a little bit, it made a very shallow double bottom here with a higher low here. Then moved back up in November over its 20-day moving average, which of course was trading by then under the 50-day, consolidated along the 50-day in the first part of November, then jumped up over the 50-day, made a little jump here, a little pivot, then pulled back in a very nice, pretty orderly uptrend, which staples tend to do that because they're not the exciting stocks. They're the ones, they make the products that people need and have to have. So it's not like a wild tech stock at all. But so many of them are overbought right now. That's why I'm looking at the XLP. So you see it now coming along. It bumped its head in the last couple of days up on the 200-day moving average, which is coming in at $72.55. So that can offer some price resistance, and it certainly did. So now we're trading back down today at $71.21. In the coming week, if the XLP stays above $70, I'm going to give it that much room. It's not a lot of room. If in the coming week the XLP stays above $70, I will add a small position, because it's still under that 200-day, which I'm watching. I will add a small position to my trading portfolio, and I'm going to put my stop at $69.75. If and when the XLP climbs up and over the 200-day moving average, I will add to my position, and of course by then my stop will be a trailing stop. So you might want to keep an eye on the XLP in the coming week. Now, if you'd like to become a more successful trader, this is a great time to check out my online training programs. You can choose from 10 different programs, including our popular flagship product, 7 Steps to Successful Trading, which takes you from beginning into quite a bit of knowledge. We also, if you'd like to learn how to swing trade successfully, that's really good for this kind of market. how to trade the trend for profits, which is what I hope we're going to do with the XLP, how to read charts, perfect for novices, 3 winning setups, great for short-term traders, bottom fish like a pro, one of my favorite things to do, and many more programs. These programs are timeless, and they will show you how to elevate your trading skill set and how to increase your gains quickly and easily. Check out all of my online training courses by going to the link on the screen right here, or simply clicking on the orange button below. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.